But by the time we hit 2007, when the Fed really dropped rates almost like they did through the pandemic, they did this in 2007, but in 2007, it didn't work.
Is the Canadian real estate crash that's going on right now like 2008? Well, I have a special guest with me, Todd Sachs from Sachs Realty, and we're going to go over this. And he has a wealth of expertise on the housing market in the United States. He's been in real estate for a long time. He owns his own brokerage in Maryland. This is his channel here. And you guys, you have to check out his channel because he has done some amazing work on here. He's interviewing people like Brent Johnson, Peter Schiff, Daniel DiMartino Booth. So definitely check him out. Todd, how are you doing, my friend?
I'm well, Luke. It's always good to see you, my friend.
Yeah, thank you so much for coming on here. So I wanted to crack things off with going back to around, 2006, 2007, when home prices initially started to go down in the United States. What was kind of going through the mind of buyers and sellers in the real estate market at that time?
It was definitely a crazy time, but what happened was it showed up first, and I have a feeling that's what we're going to see now. It's what we are seeing now here in the U.S. is it always seems to show up in the new home market first. And the reason is because, builders build houses to sell. And, when you have existing homes for sale, usually the seller can either sell or not sell. They don't have to sell unless they're distressed. And we're not seeing a whole lot of that. And we didn't see that early on in the '08 crisis either. We saw it show up with new construction. So Luke, to sort of contextualize that time period, I was building houses and renovating houses, and also I was a contractor. So, doing residential construction primarily. And really I started my business in 1989. So a long time ago. The early 90s, we experienced, some real struggles in the housing sector, and builders were struggling then, but things kind of worked their way out. And then from like 1997 until about 2005, we had just a very strong housing market. The stock market, people were taking their money out of the stock market. We saw a lot of investors, normal everyday people buying houses to get on this phenomenon that was happening with the, massive gains, year over year gains. People were literally buying a house, selling it 6 months, 8 months later, making tens of thousands of dollars, sometimes even more, doing some light renovations. And then what happened was we sort of hit the tipping point with existing homes in 2006, but we saw it in the new construction sector around 2005. And at that point in time, the paper that we have locally here, and we're in, like you said, in Maryland, and we're just our office is northern Baltimore County. I was doing a lot of work in Baltimore City at the time. The mayor at the time had a good program where investors could buy houses for literally $1, basically renovate those and sell them. So I was doing a lot of work in Baltimore City. And I can remember I was in one of my rehabs and I was looking at the Baltimore Sun paper. And I remember it like it was yesterday. And it said the overpriced Baltimore housing market. We watched things, basically the spigot kind of turned off, because who wants to overpay? I mean, when you hear back then, it was the largest bubble that we had seen, and, home prices had reached the, highest amount of unaffordability since World War II. So even though the ups and the downs, the real estate bubble that was created by then, 2005, was so big that when the headlines came out, who wanted to overpay for a house? So we instantly watched in the new home construction, the builders starting to take hits. I was one of them, right? We were just dropping prices on our houses to unload the inventory. And so from there, what happened was at 2006, prices were still climbing. So not in so much in new construction, but existing homes. So everybody was like, oh, this is crazy. Like, this is never going to happen to the existing home market. These builders just overbuilt. And so they're suffering because of that. So no one believed believed that a housing crash was coming. Even the Fed chairman at the time, Ben Bernanke, he said the banking's strong, the housing market is strong, we're not going to see a crisis. 2006, we saw the kind of the tip of the iceberg. And then from that point on, it became a landslide that by 2008, the real estate world, the agents, the loan officers, the title companies, everybody affiliated with actual real estate sales started to see it. So the builders, it hit the builders. It started hitting existing home sellers in 2007. By 2008, it was a complete bloodbath, Luke. And that ran all the way down to about 2011, 2012. So, I think the difference between today and back then is that the bubble today is much bigger, much greater. And I mean, if I look back at the history of the charts and, reread the history books from the '08 crisis, man, I think I see a lot of similarities, and it could be some hard times ahead.
I think you're right there. And it's really interesting you walking through that. And I wonder, did interest rates actually affect anything? Because I think it was like 2005, 2006, around that time, the Fed stopped hiking rates, I think it was. Did that have any effect on the market, or was it more just that was another thing and they were doing their own thing there?
That's a great question. So back in 2006, you were looking at about 7%, 7.5% for a 30-year fixed rate mortgage. You could get 6.5%. But they were doing some crazy things like giving people bridge loans, so that they could buy another property. For a period of time, they would either have a bridge loan, like they were going to sell their existing home, or they would just use a bridge loan, buy a second home. They wouldn't move into that. They would rehab it and sell it. And a lot of people got caught up in that. So people started getting into, financial difficulty. But by the time we hit 2007, when the Fed really dropped rates, almost like they did through the pandemic, they did this in 2007, but in 2007, it didn't work. It was too little too late. And what happened was, despite there being cheaper mortgages, I mean, it was already, the fallout was too big. And what it really was, it was the fact that home prices were falling so fast. And that becomes a very difficult market in itself, because, and you can just think about it this way, when a housing market is going up, when prices are going up, and what I mean by that is next month, the price of the home that you would buy today will probably cost you more money. And that's what was happening. Month over month over month, the home prices were actually going up. So what people were doing in that situation was they were paying over list price to try and buy it maybe just under what next month price may be. 3 months from now, it would still be better to bump over list price, because in 3 months from now, it would be even higher, right? So when you have a situation like that, that's why people overpay, because they're trying to beat the next price hike or what the next person would be willing to pay. Well, the opposite is also true in a falling market. So when prices start going down, and I'm talking about residential sales, especially existing home sales, because builders kind of regulate their inventory, kind of control their market. But in existing home sales, where you have a seller that wants to sell and they start getting excited about, geez, my prices are dropping, I can't get it, they're more inclined to take a lower offer. But the ones offering the price are trying to figure out, like, what do I pay? So if the house is sitting on the market for $600,000, next month it may be $550,000. So now the buyers are trying to make sure that they're giving a price that if it continues to fall next month or the month after or the month after, that they're still safe. So what happens in a down environment is the buyers kind of shut down. They kind of think about, like, whoa, maybe the market's falling, maybe I shouldn't jump in yet because I don't want to overpay. And if there's a home price correction, and that really can accelerate things quite quickly, because at the same time that the buyers are slowing down, regardless of interest rates, let's say that they can afford to buy a house right now at 7.5%, but the prices are falling, they may be more inclined to say, well, I'm going to wait it out a couple, 3 months, 4 months, and I'm going to see what happens. Well, as inventory starts to rise, that's when the prices fall. So that's what was happening a lot in the '08 crisis was that people were holding back to wait for the prices to drop even further. So even the Fed dropping the interest rate, if that makes sense, wasn't enough to excite the buyers to buy in a falling market. So I think that what we're looking at, and I don't have a crystal ball, and who knows, boy, wouldn't I like to be right or be able to be right and bank on that, right? But no one knows, especially when we're dealing with a wild card here in the U.S. With stimulus potentials and bailouts and things like that. So nobody knows exactly what the government has up their sleeve to save this market. But that's what happened back in 2007, where dropping the rates didn't work because of the falling market. I have a feeling that if the Fed drops rates here in the U.S. mid-year next year, again, we may be looking at a little bit too little, too late, because if at that point, if we have a rise in inventory and the home prices are falling, buyers will probably be more inclined to just wait for a better deal.
Yeah, Todd, that is kind of scary what you just said there, because you were obviously talking about in the context of 2007 and 2008 and what happened with rates. And we are seeing those exact same things happen right now in Canada. So inventory is shooting up, and I'm going to shoot over to this headline, which I pulled up. This video was powered by ExpressVPN, helping you get around the censorship laws in Canada. Go to expressvpn.com/market mania if you're interested in a VPN. Nobody's market, buyers waiting game to see sellers struggle. So literally the exact thing that you just described is happening right now in Canada. And I have a question on the back of that. So obviously all these people were going to the sidelines in 2007, 2008, or 2006 as well. Let's throw that in there. So a lot of people were waiting because prices were falling. So did that mean that it was the unemployment, or was it the lending, or was it a combination of both that froze them out of the market after that, so they couldn't even get in even though prices continued to fall? Or was it just a sentiment shift?
I think it was probably both. So everything was in a massive recession. And, that's what happens. I always used to say, and I sort of say it today, but I have a little bit of a different meaning when I say it. We're really talked in and out of recessionary times, I think, in my opinion, and that's why I think the media plays such a critical role, because a lot of people, Luke, they don't look into the data or the history books, right? If you want to know what's going to happen, it may not be on the exact same path, but history does have a tendency to repeat itself in a lot of different ways. And when you look at the booms and the busts of the economy, that's nothing new. It goes back to the 1700s, here in the US, when the United States was founded, really. I mean, we've had booms and busts, but what happens is the more interaction it seems that the government has, the longer the time periods become before you see the boom or the bust. And, because they will kick the can down the road and sort of artificially manipulate the markets. When the headlines of the news, if you can just, think about it. We're human beings. So when the media comes out and they say we're in a recession, like we're going to have a rough road ahead. If they say that, what do people start to do? Canceling their plans. They start pulling back on their spending. They talk about things that they need or don't need, right? So when everybody's kind of like, oh, this is great, and they're frolicking around like holiday season in a good economy, everybody's having fun and enjoying things and freely spending money. But soon as you start to hear those headlines, like in 2005, the overpriced Baltimore housing market, well, what's everybody? They're like, I don't want to overpay. Who wants to overpay? So the media has, I believe, a lot of control either in the hysteria of what happens, but then you have that aspect where I feel like we're talked in and out of recessions, so all of a sudden things are tough, and then the media comes out and says, hey, recession's over. The Fed's going to relax rates. Then we watch the stock market respond, and we have 500-point gains in one day, which is insanity when you look at the amount that these businesses are trading over their actual earnings. So it just keeps the bubble kind of going. But then you have what you just said. You have the people that their bank accounts show the results of. You can talk somebody out of a recession all you want. If they're broke and they're in massive debt and they're getting collection calls and things are breaking in their home that they can't fix, that's the real life aspect, or the carnage and wreckage that, these bubbles or these inflationary times really kind of leave behind. So, I think it was a little bit of both. I think the difference between then and now is when you look at the affordability chart, the housing affordability index, the HAI nationwide, and the National Association of Realtors publishes this. You guys can, if you're interested, you can Google it, NAR, housing affordability index. And when you look at sort of like the 100 line is sort of like what you want to pay attention to, because what that means, that 100 line in this graph essentially saying is that a median household income can afford a median home price if you're close to that 100 line. If you're over the 100 line, that means the affordability is really good. You're making a lot of money to the home prices, right? So that means, and so when you looked at like from '08 to now, or 2021, the line was much higher. That meant that people could afford a home based on their salary. For the first time in 23 years, so their chart is only showing from 2000 to 2023. For the first time in 23 years, it is under, from about 2021 to today, it is under the 100 line. And that never hit 100, or it may have just hit 100 in 2006. So, and then we had a massive crisis. So if you compare and you go, geez, if we were still able to afford houses in 2006 in the last bubble, and now we can't, what is going to happen? It could be way more, significant of a downturn than we've ever seen here in the US.
Yeah, and I think, housing affordability is so important to look at, because even though like home prices may not pay attention to that all the time, I always like to say like markets are irrational, and unfortunately housing markets have become so financialized these days that they largely act in similar ways to things like the stock market. So I think affordability is important to pay attention to, because that's the underlying fundamental. I think what a lot of people get carried away on is the fact that a lot of the time it may not trade, or it may not follow that fundamental. So they then think, oh, it's just going to be like this forever. And there's this sort of recency bias. And you probably saw that as well, I'm guessing, in the lead up to 2008, where there was a sort of bias that home values will only ever go up. They're not going to come down.
Yeah. And if you look at the chart, that is true. But, I think it's really important that the chart is adjusted to inflation and the dollar here in the US. And I don't think a lot of people pay attention to that. They only look at the price of the home. They don't look at the value of the dollar and what your dollar buys. So it isn't always the case where, you get home appreciation. And I can tell you, if you want to just go on the true mean price. And when you look at the ones that bought here in the US in a lot of the markets in 2006, it wasn't until 2022, in the spring of 2022, that a lot of these people could even hit the same mean price that they bought at in 2006. So, without having a degree in economics, which I do not, these economists, they're book smart people. I think the big disconnect here is that, what we've created are, times of artificial bubbles. And I just don't know how long that can continue. It's hard to imagine that we're going, Luke, and I don't know what it's like in Canada, but it's hard to imagine, if you just look at simple, mathematics, have a great understanding, comprehension of math. When you look at the data and try and analyze what's happening, the only thing that can happen at this point is that, there are basically three things that could happen. One is that we have a home price correction, and there's a need for a lot of different corrections, but I'm talking about shelter, I'm talking about people living in a place, buying in. Part of the strength of the U.S. economy has been people investing in a home and being established in a neighborhood and contributing to that neighborhood, right? from the local stores to the contractors, the vendors, the school systems, the everything, right? Investing in that community, their job market. We either have to see a massive price correction or we need to see massive wage growth. And I'm talking about massive. When you see houses and markets trading at 7, 8, 9 times earnings, those numbers don't work. Or we need to see interest rates from the Fed go somewhere around 0% again. And I think really that would be catastrophic in itself because it will drive the markets. The ones that are going to make out in that scenario are the investors, the hedge funds, the Wall Street companies, the corporations. Because after the damage has been done on the consumer side, if we make money free again for these Wall Street, because they always buy less. I mean, what will we go into negative interest rates? When we start talking about dropping rates to near zero again, that's not, in my opinion, a viable answer. The other thing would be, is it practical that wage growth is going to go up 30, 40%? I don't think that's practical either because employers are just as tapped out as consumers and in debt themselves, and their credit lines have been chopped and their banks have, hurt them, a lot of businesses. So in my opinion, the only thing that we can really look at is that we need a housing correction, price correction.
Totally agree. And it's funny you say that because sentiment, even in Canada right now, a lot of homeowners even would agree with that statement. They would say we need home prices to come down because they realize that if they want their kids and their grandkids to be able to afford a home, then they need home prices to go down, even if it affects them. And it's not necessarily a good thing if your home is appreciating in price. It is if you're speculating on the future value of it, but that's going to probably mean that the city's going to come in and take advantage by upping your property taxes. And lots of people are going to try and take advantage of the situation of home values going up. I think it's kind of crazy that we've got to this point where we sort of need that to happen almost. I think we've got to a dangerous point as well where the government now is doing direct stimulus to people. And I think that's because of the stigma of bailouts. I think instead of doing bank bailouts now, we're far more likely to see mortgage relief payments, these type of things, because it doesn't have that stigma of a bank bailout, even though you're indirectly bailing out the banks. Because if you're giving people mortgage relief, well, who's benefiting from that? It's really going to be the bank because that money goes to the bank. So I think it's interesting that we've got to this point. So do you believe the government and the central planners are going to allow home prices to go down? Or do you believe like the free market is just so big that it doesn't matter what they do? Like in 2006 to 2008, home prices are just going to go down and they're going to try and do whatever they did. Like they did many things in 2008, as you can probably explain, and they didn't work, right?
It worked for Wall Street. I mean, they made more money on residential housing, and they had never been in residential housing before. So when those, foreclosures were bundled up and sold to Wall Street, they had to keep them. I think it was for a minimum of 12 months, and they had to promise that they would invest in the home, make sure it was safe, and that they had to turn them into rentals so that they could rent to the same people essentially that had lost their homes to foreclosure. You said something that was very brilliant, and you said that it doesn't really do homeowners much good to see 20% annual price appreciation because if you're not planning on selling your home for any period of time, it will cost you a lot more money as a result of the value, the increase in value, but you're also getting hit with inflation, the taxes, and the insurance. But let's just say this. If you bought a house at, let's say, $120 a square foot, and now the price is $360 a square foot. Well, when you go to have that home fixed, do you think they're giving you the same pricing to fix that home that they gave you when you bought it for $120 a square foot? That just means that inflation, hyperinflation, has caused you to now spend a lot more money maintaining your home and fixing your home than you ever bargained for when you bought it at the $120 a square foot price. So it doesn't do existing homeowners. They're confused. They think that this is such a great thing, but unless you sell, and that brings me to another point. What I really want to talk about is the golden handcuffs of cheap money. Because when I do my videos, Luke, a lot of people will say in my comments, that I'm off base, I'm wrong, which is fine. I look, again, as I said, I'm not trying to be right or wrong. I'm just going off of my experience and my opinions. But when you talk about, they're saying that if you have a 3% or 3.5% mortgage, you won't sell. So this inventory is always going to stay short because you won't sell. And my argument was, well, if they want to get a job in another state, they're kind of stuck in their house because now they can't go make 20% more and live somewhere else because maybe their house is worth less than what they paid at the top of the market, but they had this great rate. And then the commenters will say, well, that you're wrong, because what they'll do is they'll just rent it out and they'll keep that house with the low mortgage. As you know, Luke, being in the industry, the issue is you have to pay the mortgage payment if you're renting it out. Not only that, but you have to pay the increase in taxes, the increase in insurance, the increase in maintenance cost, right? You're going to have evictions because it's normal that people are going to rent from you and have hard times and not pay. You're going to have to invest in that house to get it rent ready. I've been investing in real estate for 25 plus years. I've thrown tenants out and had to spend $20,000 to get it ready for the next tenant, right? So people make statements about these pie in the sky ideals. It really confuses me sometimes. Like, why would you even open up your mouth and say certain things when you don't even know what you're talking about? So when people make statements like, well, they'll just keep it and they'll just rent it out and everything's going to be rosy because they have a cheap mortgage, they're misguided. Maybe some people will get 100% blessed, highly favored, and lucky, whatever you want to call it, and never experience anything like I just said. But chances are it's not an easy business being a landlord. So Luke, I think the question is that you had asked was, will the Fed intervene? Will the Fed bail us out? What will they do? Because obviously they did something in 2008. Can they stop the crisis from happening? And, the question is, will they not just give mortgage forbearance? Because stopping somebody from the required, monthly payments for a period of like 6 months. I mean, they can't do it indefinitely, but like what they were doing with the forbearance program, and that ended, by the way, this month. They have to make their payments. The last applications they accepted was at the end of May for 6-month forbearance here in the US. But the issue becomes, we know from history that when people are not paying their mortgage payments, they're not fixing their home. So not only will the government need to provide some type of stay on making mortgage payments to where they don't have to make mortgage payments, but they'll also have to give them some type of stipend to fix up the house. And then they're going to have to make sure that the money actually goes to fixing up the house. Because we know during the pandemic, when they gave them, stimulus checks, they didn't pay their landlords, some of these people. They didn't make it a requirement to actually pay their rent. In fact, they did the exact opposite. And they said, you can stop paying your rent, despite the fact that they were paying them to be home with extra unemployment and extra stimulus money. So the government would have to take a massive role, which never really works out well in history when governments do this kind of thing. They would have to completely take control of somebody's life, essentially, and, send somebody in, make sure the roof's not leaking, fix it if it needs it, make sure the heating and air system is working, replace it or fix it if it needs it. Same with electrical systems, make sure their grass gets cut. They would have to do so many things, because what we learned from the '08 crisis is that when somebody knows that they can't afford the house that they're in, if you give them 6 months free mortgage, they're going to save as much money as they can. They're not going to fix that house up. They're going to save as much money as they can, because they know at the end of 6 months it's futile anyway, and they at least will have money in their pocket. So they're not fixing things, many of these people. So, I think it's at the point right now where it's going to have to go to free market. I don't know what the Fed is going to be able to do that may or may not work, but I know one thing is for sure, something's broken.
I totally agree. And I can't thank you enough, Todd, for coming on here. You're a wise man and your channel is fantastic. You're out there educating people. You're a business owner yourself. You've been through all these different times yourself. You know what happens. I think you're really, really spot on and on the money with what you talk about on your channel. So I want to thank you so much for coming on here. Is there any words of wisdom that you want to give people before you go here?
Well, the biggest words of advice that I can give is try not to get in debt to the banks. Try and eliminate as much of that as possible, because they're not your friends. The banks aren't your friends. And, when the issue is when we're looking at, Instagram posts and TikTok posts, and you have all these people that are like, invest in real estate, use other people's money, get, refinance, take all the equity out, use debt to your advantage. Being in debt is not to your advantage. I don't think it's ever been proven to work out well. There are very few people that actually become excessively successful using banks, being enslaved to the bank. So I would say, try and pay down those high interest credit cards as fast as you can. If you are going to refinance your house and you're in a good position, refinance at a lesser time period. Look at a 15-year mortgage. If you've been in your house, try and get out of debt as fast as you can. I think owning physical assets can be the best thing ever, because it is a good hedge against inflation, but it's not when you're, like I said, when you have a bank that can call your note, somebody that, kind of rules over top of you and bangs you with late fees and interest payments. Look at the credit cards, man. They were cheap and enticing you to spend money, and now they're whacking people over their heads. 30%, 29.99. Hey, you're down. Why don't we just kick you right in the gut when you're down and charge you even more and start penalizing you because you owe us money and we know you're stuck? And so that's the kind of thing I mean, and I appreciate your kind words, Luke, and always enjoy our conversations. Thanks for having me on your channel. People can find you on my channel as well. We always have great, in-depth conversations. The big thing is that I think we just need to live within our means.
Thank you so much, Todd. And yeah, I totally agree with Todd's statement there. I think that we're heading into inflationary times as well. And even though we might see rates go down, I believe in owning real assets as well. Todd's advice there is absolutely golden. So go check out his channel. He's putting out just amazing content that he's doing there. Thank you so much for watching this video. If you've enjoyed this video, you might like the video that's coming up on your screen right now. You might like the other playlist that I've put up for you there. If you're looking for a VPN to get around the censorship laws in Canada, go to expressvpn.com/market mania. I'll see you in the next one.
Thanks a lot.